So what was your biggest takeaway, Joe? I'm dying to hear it. You didn't nail it.
I didn't nail it, but I think, look, yesterday we had Christine Lagarde saying the data says we should wait until 2016. Today's data point, I think, undermines that. But I'd love to hear from you. What do you think?
Yeah, absolutely. You know, when I think of jobs right now and when I think of when the Fed's going to raise rates, I honestly don't even look at jobs, quite frankly, or inflation for that matter, because really inflation is moving as we expected. It's moving higher. Jobs in 175 to 225 is pretty much all we need to get the Fed off the zero bound. For me, it's really the activity data, you know, the consumer spending, the durable goods orders and things of that nature. We really need to see is more of a lift-off going to the third quarter. The good news is that it is happening, which means that our confidence that jobs will be around that level is rising as opposed to falling.
Well, something that struck my eye, though, sort of that might have been perceived as more negative was the temporary workers. I mean, they actually increased about to 20,000 from 16,000, and they're relatively high, those part-time workers, about 4.2% of the labor force. So I wonder if that is either a choice, people want to work part-time right now that they have the Affordable Care Act. I know Chad's like trying to get in here, or if it's because companies are still pretty skeptical and don't want to commit.
So I think companies are skeptical. I focus on the underemployment rate. And that underemployment rate is about 10.8%. And let's just take this into consideration. It was 8% before the Great Recession. So we still have a lot of labor slack there. Now, when it comes to wage inflation, we're going to have to see a couple more quarters of good inflation numbers from the on the wage side. But I do believe the Federal Reserve will raise in September or October, if anything, just to scotch the speculative fervor within the equity market.
So speaking of wages, there was this great chart that Deutsche Bank's Torsten Slok sent around. I think we have it. And it shows two different measures of wage growth. One is the average hourly earnings number, and the other one is the employment cost index.
There's a lot of jargon on that chart.
There's a lot out there. Well, the average hourly earnings number comes from today, the jobs report. The employment cost index is a quarterly number. It measures benefits. But the trend is up for both. And so it looks like, you know, obviously any given number is noisy, but it looks like we're heading higher.
Yeah, really, you know, you made an excellent point, you know, in terms of underemployment. What I like to focus on is the direction of underemployment. One way of measuring that is a gap between the U3 and the U6. That's an firm downtrend. Right. Now, when you look at that chart that we just saw, my money is on the ECI. The Fed prefers it. It's much more comprehensive. The hourly earnings data, there's so much noise going on there. And you've seen the momentum, and this is what I really focused on, is the tilt in the momentum. That momentum is really beginning to shift to the right side now.
But let me
We'll see more evidence of higher wages there.
But are the higher wages coming from the likes of Walmart, of Gap, of Target employees, rather than higher paying jobs? So what really is the payback when the minimum wage is raised to $15 in LA?
You're still not getting that. It's still a slow growth environment from that perspective. And you're 100% correct about that. You really also need to see, when it comes to the U.S. economy, consumer credit, aggregate mortgage debt start to actually move higher. It's still growing less than 1%, and in normalized times, that grows around 6%. And even in a recession, the growth within mortgage credit is around 3%. So this economy by no means is an escape velocity, hence the reason why Janet Yellen and company will move very slowly going into 2016. This is going to be the slowest rate increase in, well, in history.
In ever. Well, I'm really excited about today was that OPEC, the non-OPEC meeting, as it were. I think it was NOPEC, as Energy Aspect said. And my question kind of coming out of this, my big takeaway was, did OPEC prove that it no longer matters? And this is why. I point to OPEC spare capacity. So spare capacity is basically the oil you can bring on in 30 days and it lasts for 3 months. So I like to think of it as like your oil piggy bank. And that has been declining very steeply as the high production we've been seeing is coming at the expense of their piggy bank. So they don't even have the capacity to do what they did before. What do you guys think?
Well, I personally think that OPEC has no teeth right now. I think that there's dysfunction within the group, and it's always been like that. I believe that they will continue over the course of the next 12 months to continue to pump on a regular basis the way that they're doing. Hence the reason why our forecast for oil is roughly about $70 a barrel.
That's pretty bullish,
but I wouldn't
though.
be shocked, with that said, if global growth continues to decelerate, to see a $45 handle, okay, if we start to see a rapid deterioration within the economy within China.
Yeah, I mean, right now what we really have is a situation globally where there's just too much supply of oil, right? You know, in terms of demand. Now, you want demand to eventually catch up, but if The reality is that what's going on in shale production in the United States, the energy revolution in the United States, that's a game changer. And we didn't even see that coming 6 or 7 years ago. Now, OPEC is trying to squeeze that, especially Saudi Arabia. But the reality is it's going to be very difficult because the nature of that oil industry is such that it can be turned on and turned off very, very quickly. So I think that as long as they're keeping output where it is right now, it's going to be a struggle to get up towards $70 or $80 anytime soon.
The key thematic there that no one's really talking about is the demand curve for oil has shifted lower because as the World Bank and the IMF have brought in their global growth estimates, the demand curve has shifted lower, hence the reason why it's going to keep a light on it.
All right, so obviously we have to talk about Greece. And I found this to be like a pretty funny week for Greece because in the beginning of the week, it looked like the story was the big players are going to get involved. They're really going for a deal this time. Like, they're really making the push. Merkel is getting involved. And then at the end of the week, so then we had two developments that totally undermined that. One is Greece basically pushed off its IMF payment, so suddenly what looked like a real deadline is no longer. And then you had this speech from Tsipras just like an hour or so ago saying basically they're nowhere. The offer from creditors, he basically said it was complete nonsense.
Really close. He said that they're closer to a deal than ever before, but by the way, they don't like your deal.
But he says that offer from creditors is complete nonsense and they should withdraw it. So it doesn't look like they're really very close at all. So is it just more, Groundhog Day stuff in Greece?
Well, honestly, I mean, I can weigh in on this. My own view on Greece, and it's a very personal view, is that, in some measure, I think the Greeks want to be kicked out of the euro, and I think a lot of people in the euro would like to kick them out. The reality is that Greece cannot survive in the euro in its present form. It needs debt relief, pure and simple. Now, they've acceded to some pretty big demands in terms of achieving a primary surplus. That's a big deal because that's the only way you can pay down your debt. But what the Troika is looking for is something of a primary surplus.
The institutions,
they want to keep this thing going along long enough so they can get their money back, and they're basically demanding a 4.5% primary surplus. Now, the reality is, can Greece really achieve a 4.5% surplus? I don't think so.
I agree 100%. And really, the reality, this is true, is that the long-run perspective here is that a disunified Eurozone, when it comes to the political side and the fiscal disunification, is showing, and Greece is the primary example of this. So they really need to fix this in the short run. We believe that they're going to kick the can down the road. They'll get a deal in the short run. But in the long run, Greece will have to leave the Union.
You're an investor. You put money to work. Do you actually care what happens to Greece?
Well, in the short run, you could see a market, go down 5, 7, 10% on the equity side.
The U.S. market?
Yeah, the credit markets perhaps will become a little bit unstable. But in the long run, economic growth, it's going to have a marginal effect. And in reality is that global growth right now, we believe, is growing around 3%. We would be somewhat underweight equities because we are believers that the equity markets are overvalued.